This is the first video for Chapter 1. It's an introduction to accounting. So let me share my screen. And I'll start my presentation. Okay, when you think of accounting, think of information system. The purpose of accounting is to identify, record, and communicate information about business activities. A good accounting system will provide relevant, reliable, and comparable information. Relevant meaning that it will be useful to users of that information. Reliable means that what you see, you can count on, right? You have good numbers. And finally, comparable, meaning that you can take one report and compare it to another. For instance, let's say you wanted to compare this year's profit to last year's profit. And if you do your financial statements correctly, then that could be possible. In the final analysis, accounting helps users of the information make decisions. So I just want to ask you this question. If you were the owner of a business, what information would you want from your accounting system? You can pause the video and just jot a couple things down. Okay. Well, let me tell you some of the things that I think about. If I was the owner of a business, what would I want from my accounting system? Well, I want to know, did I make a profit, right? The bottom line in a business is dollars and cents, right? What is the most popular item I sell? You want to focus your efforts on things that you can sell, right? The things that aren't selling, maybe you want to de-emphasize them. What is my largest expense? You know, there's two ways to make a profit. You have to increase revenues or you have to reduce expenses. One of the largest expenses of any business is probably going to be labor, your employees. Do I have money to pay my bills? Okay, I've got a great story for you here. At this point, I'd like to talk to you about Donald Trump. No, you're saying, Tucker, don't go there. Please don't go there. This is not political. Back decades ago, when I was a young accountant, I noticed on TV that they were talking about Donald Trump going bankrupt. And I'm thinking to myself, well, how could he be going bankrupt? The guy has a yacht. He's got Trump Tower. I don't have a yacht. I don't have Trump Tower, yet I'm not going bankrupt, but he is. Well, I don't know his exact situation, but it could go something like this. When his electricity bill came in, he didn't have any money to pay it. You can't pay your electricity bill with a yacht. You can't pay your electricity bill with a big building, right? So your accounting system should allow you to plan for paying your bills. It's called, cash management. Who owes me money? Well, yeah, you want to know who owes you money so you can collect it. Do I have any slow paying customers? I had a friend that started a stationery business many years ago, and he was running into some problems because he was extending his customers credit, but they were slow to pay him. Well, meanwhile, his creditors were asking him for the money that he owed them, but he couldn't pay his creditors because he couldn't get the money from his customers. So in a good accounting system, you can identify who your slow paying customers are, and you might want to cut them off. If they won't pay you on time, that could be devastating to you. And finally, to whom do I owe money, right? That'd be to your vendors for goods and services that you bought. Now, we have two types of users of accounting information: external users and internal users. External users are not directly involved in running the organization. Internal users are directly involved in running the organization. Well, let me give you an example of an external user. I used to own Bank of America stock, right? So I'm an owner of the business, but I can't go in there and say, look, I own Bank of America, so I want you to run your branch like this. It doesn't work that way. However, I do want to see their financial statements. I want to know, are they making a profit? Am I going to get any dividends? And if not, I'm going to sell that stock. So I'm an external user. Now, internal users are directly involved in running the organization. A classic example would be managers. Managers are given resources, and they are going to use those resources to turn a profit. And the financial statements would allow the managers to know if they're doing a good job and how they can improve making profits for the company. I like this slide because it first tells us that accounting is the language of business, because it communicates data that help people make better decisions. People using accounting information are divided into two groups: external users and internal users. Well, I just talked about that, right? And I said for external users that one of the classic examples would be shareholders. But then I noticed I circled this: lenders, like banks. Now, why would a bank want a company's financial records and reports? Well, they're trying to determine if they lend that company money, will the company be able to pay them back? So lenders like banks would be an external user. Now, when we record transactions and we prepare accounting reports like an income statement and a balance sheet, we prepare those statements in according to generally accepted accounting principles. We call that GAAP. And GAAP is a common set of standards applied by accountants. GAAP helps produce relevant, reliable, and comparable information. The organizations involved in this standard setting include these three. I want to focus in on Financial Accounting Standards Board. They're the body that sets GAAP within the United States. Okay. If we're talking about international companies, well, then there's another body called the International Accounting Standards Board. And you might have heard of the Securities Exchange Commission. Well, this is a regulatory body that regulates publicly traded companies. Their goal is to protect the consumer, right? Now, as of late, the Securities Exchange Commission has given authority to FASB to issue GAAP. So the one that's most important and the one that I want you to remember is FASB, the Financial Accounting Standards Board. Now, what are some of these principles that I'm talking about? I'm going to talk about four of them. Number one is the cost principle. Assets, which are items that we own, should be recorded at cost, not market value. Cost is easily verified, where market value is subjective. You know, I used to own a 1967 Camaro. I love that thing, and I can't believe I sold it. But if I bought one, well, they're kind of expensive now. So if you guys are into vintage cars, how much do you think a 67 Camaro would go for? Well, I think it'd be worth like $40,000. Well, my buddy next to me, he really loves them, and he thinks that a 67 Camaro is worth $60,000. Well, can you imagine if I put 40,000 on my financial records and he puts in 60,000 on his, because it's just like subjective? Well, we can't rely on that. We can't rely on what we think. So instead, whatever we paid for it, we record it. Okay, so if I paid 40,000 for that Camaro, I would record that 40,000 as an asset on my balance sheet. We also have the revenue recognition principle. Okay, this states that revenue is recognized when earned. It doesn't matter if cash is received or not. Okay, let's say you're in the lawn business. So you mow this guy's lawn, and then you say, okay, that's $50, please. And he pays you $50. Well, you earned $50 in revenue. That's great. But what happens if you finish his lawn and you go, that'll be $50, please. And the guy tells you, I'll pay you later. It doesn't matter that you didn't receive the cash. You're going to record the revenue. Why? Because you earned it. You finished the job. Okay. Number 3 is the matching principle. And it basically says that expenses should be matched against the revenue. Okay. So when you have a business, you're going to earn revenues, but you're going to have expenses. And, if you can tell me of a business that doesn't have any expenses, I want in on that scam, right? I mean, everybody has expenses. And those expenses may be things that you may not even think about. Let's say that you're in the delivery business. And so you have a delivery truck and you're making these deliveries and you make $20,000 in revenue for making these deliveries. Did you really earn $20,000 and net that much? No. Why? Because your truck is wearing out. So what we need to do is we need to match the wear and tear of that truck against the revenue that truck helped produce. Let's don't even get into like fuel costs and things like that. But anyway, those expenses have to be matched against the revenue. Number 4 is full disclosure. This just states that the details behind the numbers in financial statements that would impact user decisions should be disclosed. And normally they're found in footnotes to the financial statements, right? So if there's information that's going to affect a user's decision, you need to put that in to the footnotes to the statements. In addition to the 4 principles, we have 4 assumptions. One is called the going concern assumption. It's pretty easy. It just says that businesses will continue to operate instead of being closed. That implies that when you record your property at cost, you're going to keep it at cost. It's not liquidation value because you're not going to sell them. You're going to use it. Let me give you a good example here. Let's say that you have an old company and you bought this building back in 1900 for $50,000. Well, now 120 plus years later, it's worth like 10 million. Well, on your balance sheet, are you going to keep it recorded at its $50,000 cost or at the, millions of dollars it's really worth today? Well, because of the going concern assumption, and we're not going to sell that building, we're going to keep it at cost, right? That's the important thing about the going concern assumption. Number 2 is monetary unit. This is really easy. It just states that only events that can be measured in money are recorded. The health of an owner, the quality of service, or morale of the employees are not included. Can you imagine that if we could raise Steve Jobs from the dead? He was the founder of Apple, and he was our CEO. Man, would that be something? Yeah, but we couldn't put his contribution like that in the financial records because we can't monetize that in terms of dollars and cents. And number three is the time period assumption. The life of a business can be divided into periods. And we'll see that. Oftentimes, businesses will prepare monthly financial statements. They want to know how much money they made each month. But they can also do it in quarters, which would be in 3 months increments, or in years. So you might have one income statement that shows profit for the month ended January 31. Or if you want the whole year, you could say for the year ended December 31, right? That would be the profit for the entire year. So the idea is that you can divide your business, the life of the business, into these periods. And finally, we have the business entity assumption. And this states that activities of a company should be kept separate from other business activities, including its owner. Okay, let me give you a good example. General Motors. In General Motors, they're going to have a set of books for Cadillac, and then they're going to have a set of books for Chevrolet. And you don't commingle the transactions and all the records. They have their own set of books. Okay, we keep those business entities separate. Now, if you are a sole proprietor, one owner, you need to keep your business separate from your personal life, right? You'll have a personal checking account. Then you'll have a company checking account. You'll have a personal car, and you'll have a company car. And a lot of times, sole proprietors will get in trouble because they commingle. They have one checkbook, and they're paying for their business and then paying for their personal stuff. And I'll tell you what, the IRS can really get on you for that. So remember, you got to keep them separate. You got to keep that business entity separate. Now, finally, we have 3 forms of businesses, and we count for these differently depending on what kind of business it is. We have a proprietorship, a partnership, and a corporation. Now, a sole proprietorship is simply one owner. And a partnership would have 2 or more owners, right? Called partners. What's interesting about this is that both of these forms have what we call unlimited liability. So let's say that if you're a sole proprietor or a partnership, you get sued, right? Well, if the person wins the lawsuit, they can not only go after your business assets like your company car and your company building, they can go after your house, your personal residence. They can go after your personal car. They can go after your personal checking account. So oftentimes what businesses will do is to incorporate. And for about $800 a year, you can incorporate. Even a small guy can incorporate. You think of corporations as being large, right? But that's not the case. And when you incorporate, you have limited liability. So if in a corporation, if something happens within the corporation and the corporations get sued, well, yeah, the corporation can lose the company car, the company building, the company checking account. But the guy that's suing cannot go after the stockholder's personal car and personal residence. You see what I'm saying? It's really important. My father-in-law was a pool builder, and he incorporated. He was just one guy, but this is why he did it. He told me that, he could pour a cool deck around a pool, right? And 25 years later, somebody slips and falls. Well, then he can get sued. So he wanted to protect himself. So if that happens 25 years later and he gets sued, the person that's suing him can only go after corporate assets like the corporate car, the corporate building, but the guy can't sue him for his personal residence, his house, or his personal car. And that's why we incorporate usually. There's other things too that I didn't tell you about, but for now, I think that's a good introduction to the types of businesses that we account for. Okay. That does it for this video. So until next time, study hard. Bye-bye.